Alright, hey guys, Scott here again with a brand new video, and for this one, I'll be discussing the exact situation where it's actually appropriate to double down on a losing option trade, or basically doubling the risk involved to try and bring that trade back from a loss into profits once again. And then also, of course, based on the way I said that, I'm also implying that in most cases, right, generally speaking, you should not be doubling down on losing trades at all, and I'll be discussing my reasoning for that here in a moment. Now, briefly though, before we dive in here, if you guys want the opportunity to receive up to 13 free stocks where each stock could be worth up to $2,000, then make sure you watch until the end of the video. And also here, if you would like to join a very exclusive online community where you can learn how to trade options and my overall custom approach to the markets, then you can now join my options trading Discord as well. So definitely check out the description of the video below to learn a lot more about that. And then lastly here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the video description as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1-month free trial. Alright guys, so first off in this video, we need to briefly discuss general risk management, and this is something that applies not just to options trading, but trading in general. Right? So generally speaking, it's always a good idea to keep your risk per trade very, very small. So for example, my rule of thumb is I never allocate more than 5% of my total account value for any one trade that I'm making. So for example, let's say my account has $10,000 of capital, then 5% of that is $500. So again, therefore, I'm not going to risk more than $500 for any one trade that I'm making. And the main reason for doing this, and the reason why proper risk allocation is so important, is because when you do keep your risk very small per trade, you prevent very large drawdowns from occurring when you do hit some bad losing streaks. And believe me, if you are in this game for long enough, if you're trading long enough, basically, then you are guaranteed at some point to hit some bad losing streaks. And that's because, of course, trading is literally a game of chance. And just like any game that's based on chance, at some point, something is going to happen which you thought would be super, super unlikely, because it is unlikely. But again, if you play that game for long enough, then at some point, every possible outcome will play itself out. So again, bottom line here, in order to survive some of the worst losing streaks and some of the craziest market events like crashes or bear markets, etc., you have to keep your risk very small per trade, ideally under 5%. And so having said that, that's why it's never a good idea, in my opinion, to double down on a losing trade where you're already maxed out on risk for that trade, right? So for example, if you've got a position that's already using 5% of your account, do not add more risk to that trade, right? Don't add more fuel to the fire, so to speak, because if that trade does get worse and worse and worse, and there's always a chance it could, then that fire is just going to get bigger and bigger and bigger until it consumes your entire account. And don't forget, there are ways to manage and adjust a losing trade without adding more risk on that position. And that's typically what I do, for example. So my preferred style of trading is I will allocate my full risk at trade entry. And then if that trade goes south, I will try to manage and adjust it without adding more fuel to the fire, so to speak. And ultimately, if by the end of that trade, it still ends up as a loss, then no big deal, right? Because again, I kept my risk very small at trade entry, and I never increased the amount of risk along the way. But now where it's actually appropriate to double down on a losing trade is if you by design plan to allocate, let's say 5% on the full position, but you wanted to spread that risk out across a series of much smaller trades and at different prices to basically stagger into your full position. So for example, let's say that you are bullish on Apple stock for some reason, and you intend at the beginning of the trade, before you do anything, to allocate at most 5% of your account for that one entire Apple position. And so with that in mind, you take a look at the Apple charts here, and you see that the stock has come down a little bit in the past few days. It's now reached the 20-period moving average, which you can see there in blue. So therefore, you decide to sell a put credit spread at this point to play for a short-term bounce. And for this first credit spread, you allocate only 2.5% of your full account value for that one position. So again, so far, that's only half of what you intend to fully allocate on this Apple trade. And so then a couple of days go by, and so far things are looking pretty good. Apple's bouncing nicely off that moving average, but on the next day, Apple plummets to the downside. So now, of course, this means your first put credit spread position is definitely going to be losing money. And so then at this point, you decide to double down on your existing Apple position by selling another put credit spread, but this time at a much lower and better price. And we'll say also for this second spread, you allocate another 2.5% of your account. So therefore, in total, the combined position, both put credit spreads, are now using 5% of your account. And that's exactly what you had intended to do all along. And ultimately, staggering your trade entries like this could yield a better result if Apple does recover at around this point, right? Because if that does happen, then your second spread will be profitable pretty much instantaneously, and then your first put credit spread might come back around from a loss back into maybe at least a scratch. So therefore, the combined effect would still be an overall net profit, as opposed to placing both put credit spreads at the same time and then Apple stock plummets. You would have much larger losses in that case. And then ultimately, if Apple did recover a little bit and both spreads came back to a scratch, well, the combined effect is that whole position is still going to be just a scratch. But bottom line here, guys, I'll say it one more time just for more emphasis here. Do not double down on a losing trade if you are already maxed out on risk for that position. Do what you can to manage it and adjust it without adding more fuel to the fire. So unless it's your intention to take your max risk allocation for a trade and break that up over a series of smaller trades to stagger your entry, then don't double down at all. And so with that being said here, that's going to do it for this video. But of course, one last thing, as I mentioned at the beginning of the video, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the video description below to sign up and get your free stocks. And also, don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the video description. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.